Welcome to the Property Profits Real Estate Podcast, the show where real estate investors talk strategy, capital, deals, and growth with your host, Dave Dubeau.
Hey, folks, welcome back. Today, our special guest zooming in is Matthew Sioum, and Matthew works with some old friends at the Rent to Retirement Company. So, Matthew, welcome to the show. Great to have you.
I appreciate you having me on, Dave. Thank you.
So, Matthew, it's been a while since I interviewed Zach and some of the other guys at the company. So remind everybody, what exactly is Rent to Retirement? What kind of real estate investing are you guys focused on? What service do you provide? Just give us a big picture overview.
Yeah, absolutely. So Zach is our CEO. I'm part of our executive team here. And Rent to Retirement, we are the largest turnkey real estate provider in the nation. So we offer turnkey real estate to investors out of their own state most of the time. Turnkey means a lot of things to different people. So for us, it means that the properties are rent ready. We've analyzed city, state, market, and property. We just take it a step further because we also put you in touch with the team around the property to help you manage that from a distance, right? Lenders, property managers, homeowners, insurance agents, the whole 9 yards.
Okay, so what kind of properties?
Yeah, so currently our inventory, it's about 60-40. So 60% new construction, and that's built within the last 3 years max, to 40% of the inventory being what we call turnkey rehabs. Those are older homes in existing markets that have been renovated within the last 6 weeks.
And you focus 100% on single family detached. What does the kind of property look like?
Yeah, great question. So mostly would be single family. We do currently actually have duplexes as well. We have the occasional fourplex or townhome, just depending on the numbers that we've vetted out that are most advantageous. But we really cap it at about the fourplexes, right? We try to keep our investors in the. We don't want to go into the commercial space when you're talking about 20 or 30 units.
Okay, very good. So let's walk through how this works. So
Sure.
You guys, you say it's 60-40 new build to existing.
Yeah.
Let's talk about the new build side of things. Walk me through
Sure.
how that works.
Yeah, good question. So I like to tell my investors it is a standard real estate transaction, right?
So let's pretend you're talking to somebody who hasn't done any standard real estate transactions yet. So
yeah, let's talk about it.
most of our folks have, but let's just keep it super simple.
Absolutely. So Dave, you come to me and you say, hey, Matthew, I want to purchase a property, or you come to one of our strategists, you would have a conversation and we'd figure out your runway, your turn times, your budget, your goals, your age, your career, all of these things to make sure we're both a fit for each other. You would then get pre-approved by a lender. Once you're pre-approved, we take your pre-approval letter, your budget, and then what properties we actually have available. And we're actually able to build a strategy with you. Now, a couple questions I'm asked all the time. When I meant by it's a regular real estate transaction, once someone says, hey, I want to move forward with this property on 123 Main Street, we would reach out to the seller. They would send a purchase agreement. You're under contract 30 days. You have inspections, appraisals. I think the one big difference that I like to outline is we put you in touch with your property manager about a week before you close. That way it's a seamless transaction or transition into the closing. But once you actually close on that property, the keys go from lender to property manager, and then you're saving for the next one. Right?
So how do you guys make money?
Yeah, great question. So Rent to Retirement, we are a marketing platform, right? So we collect a marketing fee from the seller outside of closing. So if you see a property for $300,000, we expect the property to appraise at $300,000. We collect a marketing fee outside of that because of the volume of business we do. So I guess a little business background for your listeners. Rent to Retirement, we've been in business coming up on 12 years, and we do about 40 transactions a month. I only bring that up because at that volume, we're able to negotiate a lot differently too. So people will get on our site and they'll see, well, why do you have this incentive, but that builder doesn't show that incentive anywhere on the MLS or on Zillow? It's the volume relationship. We have access to builders' wholesale divisions, not just their retail side. So they're paying us.
So that's the new build side of things. How does it work with the rehab side of things?
Yeah,
so on a bit more involved in that side.
Yeah, great question. So no, we do not. We try to separate church and state as best as we can. So we're not doing the rehabs. We have rehabbers that are already out there, already established, right? They're running their own business. We do vet them thoroughly, right? We expect them to do good work. We've built those relationships over years and years. That said, we collect a marketing fee from rehabbers just the same.
Okay.
But the investor's not involved with having to deal with a construction site when they're purchasing property.
Okay. All right.
Yeah.
So you guys are the intermediary. You're
Yep.
doing the marketing to find people who are interested in turnkey properties.
Yep.
You're vetting the builders, you're vetting the flippers or rehabbers,
Yeah.
and you're kind of connecting folks in the middle. Am I
Exactly
understanding?
right.
Yeah. Okay.
Yep.
Cool. Very, very good. All right. Very good. So obviously you've drunk the Kool-Aid around the whole turnkey business side of things.
Sure.
It's not always sunshine and flowers, Matthew. So what are some of the potential pitfalls to this way of investing in real estate?
Yeah, that's a great question. I'm gonna, and not to start too much on my story, but quick background on me. I started with a house hack into doing it remotely with a contractor, and you're just on the phone hoping it works, right? And so the quick answer to your question is, we aren't the best fit for people that feel like they have a lot of time and energy and want to exert themselves, right? They want to physically go and fix a house. Is there more meat on that bone? Idealistically, sure, right? If you go in and you're flipping a home yourself, absolutely. I would say that we are more tailored to the busy individual who just wants to use a different avenue for their capital, right? They're already busy with their work life or their personal life. If you're saying, hey, Matthew, I want to fly to, I live in California and I want to fly to Texas 3 times during the 30 days to check on everything, we're probably not going to be the best fit, not because we don't want you to go. We're happy to accommodate, right? But the fact is, these are properties at value that are just consistent long-term investments. These aren't, for example, on the rehab side, something you're going to go and put a new kitchen floor in and add 10,000 to your equity, right? You're not forcing equity in that. So that's probably the one piece I would mention. The other part to that being that our investors are a lot more interested in big picture, right? And so what I mean by that is they're looking to be consistent in their purchase process over the next 5 to 10 years, right? They're not hoping to buy one property and expecting it to appraise for $50,000 more in 3 years from now. And so it's just kind of that balancing act, especially with, feels like on the internet, it's a lot of 22-year-old Airbnb millionaires, right? Real estate, you're not putting a Ferrari in the garage on the first 2, 3, 4 deals. So that's kind of where we play.
Got it. So walk me through it. Well, like, is there much difference price wise in the rehab properties versus the build to rent brand new ones?
Yeah, absolutely. And all of your investors have different situations, so I don't want to pigeonhole anyone. But if I had to go 30,000 feet for just a moment, the rehab side, those are lower price points, lower down payments. So there's a lower entry mark. And the nice part about that is you're quicker to the cash flow, right? You're talking in those properties, and I'm originally from DC, so your coastal investors might be floored, but that's $135,000 to $165,000 for a really good property that someone in the Midwest is going to love to live in, right? Mm-hmm. And you're quicker to your ROI there because you're in that deal for $40,000 to $50,000. And all this information is available on our website. The new construction, those are higher price points, higher down payment, so higher barrier of entry, but a lot higher ceiling in terms of appreciation. Those are in secondary, tertiary markets outside of major cities. They're new builds, right? So they're longer runway to appreciation there. Those purchase prices, I mean, you're talking up to $600,000 for a duplex in parts of Texas, right? Or $290,000 to $350,000 for single family homes. So it is a larger price point, which probably brings me to the biggest piece of this. The incentives on the new construction, I mean, for lack of a better word, it's pretty absurd just because of the relationships we have. I think currently we're running, a builder just reached out to us a couple weeks ago, and they are offering our investors, the total incentive package is $106,000.
What does that mean?
So the total incentive package, meaning the buy downs, the cash back, the 2 years worth of free property management, totals to $107,000 worth of incentives to someone who's buying a $595,000 duplex, right? With a part of that 170 or 107 being $89,000 back in cash. So it's it's situations like that that allow people to be really creative in how they're scaling up.
What kind of cash on cash returns are people looking for with these kind of deals? Like what's the
Yeah,
back end profitability for your clients typically? Each
great
deal is
question.
different, I understand, but
Yeah, so assuming that they're going for the standard cash flow product, right? Odds are they're going to be anywhere from 13 to 17% ROI. Now, we calculate ROI as cash on cash from cash flow, as well as a standard 27 and a half year depreciation tax schedule, right? So it's the combination of those two numbers in the ROI we're speaking on. Now, we have other investors that are more intentional, and so they'll say, hey, I don't want to take the buy down. I'll take all of that incentive money back in cash. They'll know they're going to be either break even or a little cash flow negative, but they're using that cash back to then turn around and scale, right? In those situations, their ROI is a little different based on their tax situation, but yeah, you're looking at about low to mid teens on the new construction. And then we've seen ROI as high as 19, 20% on some of the rehab properties when you're talking about Akron, Ohio, cash flowing $400 a month at, $38,000 down. So
yeah, very cool. All right. Who are your typical buyers? Like who's your standard kind of person that comes and works with you guys?
Such a good question. So international and domestic buyers is the same, but I would say there's two big buckets. And if you're not in one of these two buckets, call us anyway. We'd love to talk to you. But one of them being, like I mentioned earlier, just the low bandwidth, that low bandwidth individual. And it's not just, hey, I'm a surgeon and I don't have any time, which is very common, right? But it's also, hey, I'm happy in what I do for work. I have 5 kids. I'm busy with summertime, right? Whatever the case might be, but I still want to invest. I just don't want to spend 6 hours a week looking for the right deal and vetting that out. So that's definitely one bucket. The time constraint. The other one is just more of the investor who maybe does have the time, does have the energy, does want to learn, but they don't want to dive in solo, right? The internet is a big place. And so we have investors who just want a little bit more hand-holding, for lack of a better word. And they have a strategist assigned to them. That's the other piece about this, right? Is I have investors I've worked with for 3-4 years now who will just text me an address off of our inventory sheet if it's something they like. And I already know what they're looking for. They already have the contacts to the lenders. They already know their property manager. And so that just creates a kind of a long-lasting relationship that makes them feel like they have somebody in their corner. So I'd say it's one of those two buckets.
How involved are you guys in the ongoing property management? Because, that can definitely make or break a deal.
100%.
You get a crappy property manager in there and you're living in California, your property's in Florida. Yeah. It turns into a nightmare very, very quickly. So
very true.
How do you guys help manage that?
Yeah, good question. So I like to let people know right up front, right? Our phones don't just turn off after you close. You still have access to your strategist front to back. That being said, we don't manage the properties. We do vet the property managers thoroughly. I mean, we're looking at communication feedback loops, how many doors they manage, how long they've been in business. We're considering all those things all the way down to their vacancy rate. So we don't work with property managers that aren't able to find tenants within 4 to 8 weeks post-closing. That 4 to 8 week quote is our year-round quote. It's obviously a lot shorter now that we're in the warm months. But we take all of that into account. So that's one part of the answer. The other part is, yes, your day-to-day is with that property manager. From a business standpoint, you're not just Dave with a property going to that PM, right? You're Dave with Rent to Retirement, and they know how much business comes behind making sure they're happy, that you're happy, So that's the other piece is we don't have a ton of issues with our property management teams because we vet those relationships so closely. If something arises, our investors are typically reaching out to both their PM and to their strategist. And then we're able to kind of jump in where we can be helpful, just depending on the situation.
Quarterback the situation. Yeah, that makes sense.
Yeah.
Awesome, Matthew. Well, hey, thanks for reminding me all about Rent to Retirement, what you guys do. I think that's a valuable service. Who are you looking to connect with these days?
So if you are interested in real estate with, I would say a starting capital number would be $35,000 and up. If you have $35,000 and up and you want a long-term investment with some consistency behind those considerations, reach out to us. It's renttoretirement.com. We're not asking for a drop of blood for you to get information. You can actually see all of our inventory, the brochures, the operating expenses, the pro formas, purchase prices. All of it is publicly available. Just go to renttoretirement.com. You can see our inventory, and then you can actually schedule a call with one of our strategists from there.
Fantastic. Matthew, thanks for being on the show.
Appreciate you, Dave. Have a good one.
All right, everybody, take care. We'll see you on the next one.
Thanks for listening to the Property Profits Podcast. If you'd like to be a guest on the show, apply at daveinterviews.com.